In this week's update, rising inflation appears fundamentally unavoidable. Best form of defence is attack, and gold and Bitcoin are on the march. My name's Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. Donald Trump is back. We thought he'd left the stage for a while, but he's back on social media and he's back disrupting things with the proposal of 50% tariffs on the EU. So I pose the obvious question, does he not learn anything the last time he brought the world's global financial system via the bond market to the brink? And the reaction this time, not quite as bad, but appears he hasn't learned a great deal. And he's also talking about applying 25% tariffs on Apple iPhones that are made outside of the US. So none of these things are good for stock markets or for any part of the market, to be honest. So the bond market, which is the key market in the world to follow and be concerned about how it's behaving, it hates the outlook, hates it with a passion. So we've got a combination of factors: US credit rating downgrade, Trump's tax and spending bill has passed through the House. That means deficit spiral gets worse, was probably going to get worse anyway, whether that bill passed or not. We've now got tariffs back on the agenda just when we thought maybe things were softening with respect to tariffs. Looks like Trump's not going to get rid of that one. And it's all inflationary. It just has to be. It hasn't manifested itself yet, but that doesn't mean that we're not getting inflation baked into the pipeline. It's almost certain that that is coming. The bond market is confirming it because we've got rising 10-year and 30-year bond yields. That means that the people who buy the US debt, who lend money to the US government, are demanding a higher premium. They don't want to buy it, basically, at the current premium. They want a higher premium to justify the risk. So the US bond market is confirming it, and other markets are confirming it as well, but I'll get to that in just a minute. And the US consumer sentiment is the second lowest on record. And that's a huge deal for the American economy because the American economy is 70% about the consumer. So these are not small matters at all that the equities market can just continue to look past. So it raises the question, what is the prudent way forward? And let me be clear here, I'm not making any particular statement or position on what I think the equities market will do. Regular viewers will know that I'm at pains to avoid forming a firm opinion because it kind of sticks you to the spot, if you like. So I like to keep my mind open. But there are times when you can position yourself a bit more prudently than normal. And I think we are entering into a period where that is the case. Now, that doesn't necessarily mean that you need to change your approach. And I won't be changing my fundamental approach with the bulk of my portfolio one little bit. However, I am prudently packing some other safety guards, if you like, around the outside. And that's what this video is essentially about. So for me, the prudent way forward is the bond market is telling us that there is a big change upon us. Now, we've been here several times before and then everything has gone back to normal. But at some point, whether it's now or at some point in the future, the bond market is not going to just calmly return to normal. So we'll have to wait and see on that one. And when you stand back and think about it, lending the US government money, which is what you're doing when you're buying the bonds, for 10 years or for 30 years at very low rates, down in the 1% area after COVID, but also at the moment, we've now got the 30-year rate having gone back above 5% and the 10-year rate at 4.6. That only makes sense if you believe that inflation is going to stay very low. Otherwise, it makes absolutely no sense at all. It's the worst strategy in the world. And as we saw on the previous slide, there's a lot of things that are heading in the direction of higher inflation. So for me, it's not an automatic that inflation is going to trend back down into the Fed's range. I just don't think that is a given. So what if the game slows down? What if the main buyers of US government debt decide that they don't want to play that game anymore? They're going to stop lending to the US government, but the US government spending doesn't stop. What is the outcome of that? Now, to a degree, it's an unknown, but markets have a way of forcing the rates to rise. This is not just something that the Fed can control with the cash rate. Markets will push the yield to a level that may be unacceptable. And that may mean that the Fed has to step in and become the buyer of last resort. And then, you're really starting to teeter on the edge. So these are the things that are in the back of my mind. They're fundamental. They're logical. You can build a logical argument around it. But as we know, logic doesn't always play out in the market. But I think the odds of an inflationary spiral are becoming larger from everything that the bond market is telling us. And some of the alternative currencies, if you like, are telling us that as well. Gold is telling us that. Bitcoin is telling us that with a breakout. So alternatives and the bond market are telling us that things aren't happy. There's a 30-year yield over the last couple of years. So you can see we've now returned to the 5% level on the 30-year yield. And to get a perspective on what that means, let's have a look at the 30-year bond yield back to 1990. So we were going through a period from 1990, or before that, to 2020 of a long-term downtrend in the 30-year yield. But over the last 4.5 years, look at what's happened. And the 30-year yield on a big picture view now looks very different. And a couple of observations of this chart is, first of all, we've clearly got higher highs and higher lows. When you get away from the day-to-day noise of the market going up and down, the long-term trend is unquestionably up. And also look at the rate of ascent of that curve. It's quite steep. So we're now getting back to a level that is starting to become a problem. And back in the 1990s and 2000s, I don't know what the US deficit was at that stage, but it was nowhere near the 33 trillion that it is at the moment. And so a rising yield, and it's, that's what we've got. We've got a rapidly rising 10-year yield, 30-year yield on a big picture view. That creates enormous pressure for debt servicing. So you can't look at that curve and conclude anything other than we've had a long-term, big picture, very significant reversal in the bond market. Now, does that just quietly settle down like a swan descending onto a lake? I doubt it. And certainly I doubt it even more with Trump in the White House. So this chart has been telling us for a couple of years, till we started breaking some of these prior highs, could have just been going into a sideways consolidation. But now we've got something far more definitive. All right, so that is what the bond market is telling us. What is the impact of that on the broader stock market? That's the key question for investors. And it's almost impossible to argue that it's positive. So it's not that. Is it neutral? Will the stock market continue to ignore it? Or, as logic would dictate, at some point it's going to be negative. Now, you've got to remember that logic often doesn't play out the way you'd expect. So you don't want to take fright from this. This is just something to be aware of. It's one of the key things that I'm monitoring so that we don't get caught with our pants down. That's the objective of this video, is not to guide investors towards doing anything different. It's just be on alert, because there could be changes already in train that could be significant. So the impact on the broader stock market, I think the probability around that has to be negative. That's the whole stock market, not individual parts of it. Debt servicing is a real issue that can lead to living standards falling. And I don't think there's much doubt about that in America or in Australia. Living standards are in long-term decline in many Western countries. A recession can't be ruled out in America in this case, and that would then lead to falling corporate profits and a reaction from the stock market. It would just have to. Now, in that environment, indices could still rise, but only if the valuations keep rising as well. So the enthusiasm that we've seen over the last decades, where seemingly the American market just marches higher and higher in terms of its valuation. But the higher that the PE ratios or the market multiples rise, then the more likely it is that you end up with market volatility or market instability. Now, because I don't involve myself in the broad market and haven't done for years and years and years, and encourage all of members of my services to do the same, we're only targeting a sliver of the market. What is likely to be the impact on the stocks that I would call the best of the best? These are stocks that have the characteristics that mean that their earnings just continue to grow strongly no matter what. GFC, COVID, doesn't matter. Their earnings just keep growing. Now, percentage-wise, there's not that many of them, but there's certainly more than enough to fill anyone's portfolio. So why wouldn't you just do that? So the impact on the best of the best stocks is possibly not very much at all in the long term. But when stock markets sentiment gets poor and the indices go down, then all stocks tend to get impacted for a short period. Then we get short-term volatility. And we saw that during March and April. And not too many stocks escape. The best of the best tend to go down the least. They tend to rebound the quickest and the soonest. And they go on and they create new highs. So I would expect that if you're just dealing in this sliver of the market, as we are, that you're going to see short-term volatility. I don't think there's anything to avoid that. But in the long term, the impact, probably not a lot, because the sort of stocks that we're investing in tend to sail through all of the macro impacts. So only owning the best of the best is just, what we do. So what are the factors that create those stocks? And I've talked about that very, very regularly in these Sunday videos. The factors that go along with creating those sort of significant outperformance. And founder-led stocks are a great source of those sorts of situations. I won't go into detail because I've done it so many times before, but knowing where to find them, having a plan for how you enter them and how you manage them produces very good results over the long term on a relative basis, much superior to the rest of the market. The second thing that you can do, as well as just owning the best of the best, is to then hedge the volatility just to make life easier on your psychology. Now, gold in its varying forms, whether it's physical gold or gold ETFs or stocks or stock ETFs, whichever form you want to hold exposure to gold in, then that is one way to do that. Now, often in the short term, gold doesn't work too well as a hedge because there are other short-term dynamics going on. But over the long term, it does. And the other area that may well be coming into focus now is, I'll call it the Bitcoin-related sector, because it's not just Bitcoin itself. The service providers to the Bitcoin sector, companies that are selling the picks and shovels that makes the Bitcoin sector work. So it could well be that will come in and start to be increasingly perceived as a hedge to the sort of volatility that may occur. All right, so once again, really important, I cover this every week, and the relatively rare circumstances we find ourselves in now where we have a set of US government policies that are just so different from anything we've ever seen before, it's easy to lose money in the stock market. And I think it's going to get easier and easier to lose money in the stock market over time as the world's financial system gets more and more stretched. So it's vital that you get all the right sorts of advice, investment, financial, legal, etc., that you need to do this properly, because the consequences of not doing this properly aren't particularly pretty. Now, if we look at American stocks for the week, the S&P was down 2.6% for the week, and the NASDAQ roughly the same, 2.4%. The Russell 2000 for small caps was down 3.5%. The equal weight S&P only down 1%. So that was an interesting divergence from the S&P. The indices are still rising. So when we get to the charts, you'll see that we've still got clearly an uptrend that started 4 to 6 weeks ago. But we're just starting to see some evidence that maybe the sellers have decided to come back into the market. They're flexing their muscles a little bit. So the key question is this just a bit of momentum waning? Are we going into a consolidation? Or is this just a short-term pause for a couple of days and then the market will continue higher? Don't know the answer to that. We don't have enough data, but we should have a much better handle on it by the end of next week. It'll test how strong the buy side is. If indices are able to pull back significantly, then the buy side still is not prepared to step up. One thing that does appear to be occurring, and I think Trump has just firmly put it back on the agenda with the EU tariffs, is that global investors are reducing their exposure to US assets, be they bonds, be they stocks, currencies, whatever. And that has very significant ramifications for all asset classes all around the world. The US dollar has fallen. It was back up to 102 last week. It's fallen now back under 100 and not looking particularly good. So the theme of selling America, which we thought maybe when Trump backed off the tariffs and created this 90-day pause period, we seem to be back in a situation now where sell American assets is back. And the 10-year yield is 4.52%, so it's back up again. And the VIX, which got down to about 17, I think, last week, is back up to 22. So this is the NASDAQ on a weekly chart. So you can see we've had 5 or 6 very, very strong weeks with gaps that has recovered almost all of the losses from the end of February. Let's zero in on the week we've just had. So is this just a pause, similar to what this week here was? Or is this something different? So if we go to a daily and just look at the nature of the candles, again, we don't have enough information to indicate that that is the case. And all you can do is go with what you see. So all through here, we've had plenty of gaps to the upside. And most of the candles are green, which means that the market has closed higher than it's opened. So that indicates an enthusiasm for the buyers to buy after perhaps some initial volatility, which often is just announcement driven. And then we had a different day on last Wednesday where the market gapped down, it then traded up, but then lost it all and some more as well. Thursday was an indecision day, nothing much happening. And then we got a gap down on Friday, but once again, the buyers stepped up, and that gap down was due to the EU tariffs. But it didn't stop the buyers stepping in and taking the market back up again, almost to neutral, and then there was a bit of a sell-off in the last hour. So it's a very neutral picture at the moment. I don't think you can draw any conclusion from that. So the data for next week is vital. If we look at some of the spreads, this is the S&P versus gold, and it got back up to a key ratio level and has abruptly turned back down again as the S&P cooled off and gold took off again. Consumer discretionary versus consumer staples was certainly looking a lot better before the week just done, but we're back now into a point of indecision. If we look at semiconductors on a weekly chart, again, Is this a pause? We had great gaps. We had a terrific move, 5 of the last 6 weeks. Is this just a pause? We need more information. On a relative sector basis over the last month, technology was absolutely killing it. So was consumer discretionary, and so was communication services. So they're the most aggressive sectors of the US market. That's where the money was flowing very clearly. But in the last couple of days, it's turned back down again, and basically money flowing out of just about anything except for energy, which is helped very much by uranium, and also consumer staples. So energy and consumer staples were the only sectors to turn up a little bit towards the end of the week. If we look at what happened in Australia, technology just had an absolutely cracking week, and there was no softness there at the end. Energy has picked up a little bit, and given what happened with uranium, we should see the energy sector, perhaps not oil, but the energy sector, do reasonably well on Monday. And then we have small caps. So small caps did well, and certainly that was our experience towards the end of the week. We had some terrific outcomes. And then at the bottom, we've got the banks, we've got healthcare, and we've got materials. So that is where the money is flowing in both markets. Now, looking at the S&P, it's the S&P on a daily. It looks very similar, of course, to the NASDAQ. Hugely positive, lots of gaps higher. And then we've got a couple of days of indecision, which is not really resolved at this point in time. So this week coming is really important. And this is RSP, and finishing off with the Russell on a weekly chart. So that's where we sit with the US market. Turning to the Aussie market, our dollar has pushed up with the US dollar weakness, 64.39. So we're back into a weakening trend now for the US dollar. And that's becoming a definite trend, as you'll see from the chart. Our index rose 0.2% for the week. No real feel for how it's going to open on Monday. Energy, of course, and uranium stocks will do well here on Monday as well. Technology continues to lead, as we saw, and the stocks that I colloquially call the best of the best continue to trend very hard, and we had some excellent outcomes during the week. All right, let's just look at a few charts before we go to precious metals. So first of all, the US dollar. So we rallied back, so we broke this very important support that I've been highlighting now for a number of weeks. That is a very meaningful breakdown. We rallied back above this support resistance line. That's pretty normal. Bit of overrun on both sides. But now we've quite abruptly turned around. So not much time transpired, and we've suddenly gone from 102 and we closed at 99. So that's a very significant move. And the Australian dollar, of course, reflects that in the opposite direction. To precious metals, it ended up being a great week for gold. Jumped back up $157 after last week's selling, and back to $33.59. Translate that to Aussie dollars, it rose a couple of $100 because gold went up far more than our currency went up, so 51.93 in Australian dollars. Silver did really well, up to 34.26. We might finally see silver staging a breakout. And an interesting bit of statistics, the April imports of gold into China was the highest level in 11 months. So it looks like they had a little bit of a holiday, but they've now come back with a vengeance in terms of their gold buying. When we look at stocks, they're becoming more volatile. We're seeing more significant rapid moves. It's hardly a smooth trend over the last few weeks, so it is becoming more volatile, but the upward trend in precious metal stocks certainly remains. So if we first of all look at Bitcoin as well. So there's Bitcoin. Now Bitcoin on Thursday, Friday, I'm not sure exactly what part of the sessions they were, but Bitcoin hit 111,700. Now, once the EU, I think this corresponds correctly, once the EU tariffs were announced, then Bitcoin got sold off because it's still a bit of a risk-on kind of asset. So it got sold off and closed down at 107, but we did get a breakout, as you can see. So that is very promising for Bitcoin. There's the Australian dollar gold price. In US dollars, on a daily chart, it's certainly got quite volatile. If you look at the last period here since, say, the middle of April, you look at the volatility around that compared to the volatility that we had up through here. So from the end of December until we got through to April was a very smooth progression, but it's now become much more volatile, much more erratic. And silver on a weekly basis had a much better week. It is getting back up towards challenging this $35 area again. Moving on to Bitcoin, we got a breakout, as I just showed you. We've definitely got price momentum building in Bitcoin. We've also got acceptance building. Almost every week, I read articles that such and such an institution is increasing their exposure or increasing their hedging or increasing their use of. But there's no question there is greater acceptance every week, every month to Bitcoin being perceived as a mainstream asset, more than I've ever seen in the past. So we got to 11,700 on Friday night, and then Trump did his thing. I think there's a chance that Bitcoin is now starting to be seen a bit as a mainstream tool, mainstream asset, and possibly even as a hedging tool. And that would be an incredible shift in attitude from, let's say, 5 years ago, where cryptocurrencies were still being derided in most places. Now, market dynamics always confuse the picture in the shorter term. We see that with gold. Gold should act as a hedge, but when markets first start to unravel, gold gets sold off as well. Gold and gold stocks get sold off savagely for liquidity reasons, because they are being sold to help with margin calls and the like. So gold is not a good short-term hedge either. It's a good long-term hedge, but not necessarily a short-term hedge. And so I don't think that we're going to see Bitcoin becoming a hedge in the same way that, let's say, the consumer staples sector or utilities will generally not go down at all, or may only go down a little bit. So I think in the short term, we're still going to see it perceived as a risk-on asset, but in the longer term, it could start to be embraced as a hedging alternative. And when you think about Bitcoin, it's not hard to envisage logically a scenario where we know that supply is capped, and yet major player after major player, and eventually some governments, are going to start to increase their exposure to Bitcoin, and their current holdings are absolutely minuscule. What does that do to the Bitcoin price? I'm not making any prediction around this area, but you can certainly project a significant increase when you've got that sort of scenario. Fixed supply and increasing demand. Turning now to other commodities, copper spiked up to 483. Nickel was pretty steady around the $7 mark. And copper stocks, just maybe it's temporary and maybe it'll go back again like it has so many times in the last few years. But I get the sense that copper stocks are just starting to catch a bit more of a bid than they have in the past. So that's certainly an area to watch. Crude oil, 61.5, not a lot of change there. Big picture level, we've broken very, very important support. It's still in a strong downtrend on a big picture level. In the short term, it's a very confusing picture for me. Uranium, fundamentally, the outlook has been very strong for a number of years. I first started talking about and investing in uranium back in 2019, which turned out to be way, way too early. So there's been a strong outlook for a lot of time, and that's always made sense. But the price action has been unpredictable. It's been erratic. We've seen uranium stocks soar. We've seen them get absolutely crushed, and now we're starting to see them rapidly rise again. But it's a sector that is very difficult to capture. You've certainly got to bring a contrarian mindset to exploiting the uranium sector. And the problem with uranium is that the only real market that we've got is the spot price, and that's not commercial reality. Probably not even close. So that's the difficulty that markets grapple with when it comes to uranium. And then we've got Trump's executive order on nuclear. That's got to be a big tailwind and could be one of the significant reasons why uranium has done so well in the last week. Now, last week, I proposed that the divergence in uranium stocks could have been an opportunity. So we had uranium stocks not really lining up with what the uranium spot price was doing. Prices were down since January 24, but long-term the fundamentals remain strong. And we've had a big surge in uranium stocks just in the last week. So hopefully some investors were able to take advantage of that. All right, let's look at a few charts. There's the spot copper chart back up above $4.80. There's a uranium spot chart. We're back now to 72 and change. So that's been quite a strong rebound. I didn't ever understand how and why it got down to 65 in the first place. Final thoughts, how to prosper in uncertain times. I proposed that question last week, and given what I've presented this week, it's worth revisiting that situation. Not that you need to change anything dramatically, but I think just be more prepared to change your position if the price action warrants it. Broadening the high growth, high probability level of diversification is an option that you've got. So for me, rather than going into your shell and go to cash or go and buy consumer staple stocks, that to me is not the way forward at all. There are so many good parts of the market. The best form of defense is attack. And there are other areas that can be considered, such as emerging markets, such as cryptocurrencies, and certainly the stocks, whether they be in Australia or elsewhere, that have got high probability, high growth. As long as you maintain your diversification within that narrow sliver of the market, then I think you can still do very well, even if markets become difficult again. So for many investors, a way to think about the journey forward is not to go into your shell, but to continue with the high growth, high probability stocks, but couple them with some long-term hedging alternatives, such as gold, for one. I think that general approach to the market provides the opportunity for well above average returns, particularly if the market return is negative. Plus, it gives you a means to stay the journey. So if you've got some alternative assets that are going to outperform the general stock market, it may outperform by just not going down less, but that's okay. Then that gives you an opportunity to stay the journey, if you like, with your main high growth, high probability assets. All it requires is you just got to be clear about what your purpose and your process is and have the confidence that you're on the right track. They're the keys. Portfolio Analyst this week coming. We're doing an episode of Taking Stock of the month of May. It's 1 week earlier than normal, but I'm going to be doing a little bit of travelling, so there will be an absence of the Sunday video a couple of times over the next few weeks. There will also be some more very insightful questions through Q&A. There's been some questions of late that are just fantastic learning points that members have been able to take part in. So that's it for this edition. No Sunday video next week, probably one the week after that though. More information on the website. There's my email address, and I'll be back with you in a couple of weeks. Cheers.